Good evening, everyone. We're going to wait just a couple more minutes to let other people join. So we will get started here in about 1 minute. So good evening, everyone. And we really want to thank you for joining us for Markets, Margins, and Protection, a 360-degree view of the cattle industry. As a quick reminder, all attendees are muted and videos are shut off. However, we'd love for you to engage with our presenters today by using the chat feature found at the bottom of your screen. If you can find the chat feature by clicking the three dots on the bottom of your screen if you're using a mobile device, or select chat if you're joining from a computer. Before we begin, I'd like to introduce our experts on the call today. First is Mary Kurzweil. She is an analyst at CattleFacts, followed by Dr. Marin Bozic, CEO and founder of Bozic LLC, and lastly, Austin Robinson, livestock production specialist with Farm Credit Mid-America. As a reminder, this webinar is intended for informational purposes only and is not public or media consumption. Any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. With that, thank you for joining us, and this event will be recorded and distributed following the webinar. Mary, I'll turn it over to you.
Great, thanks, Hillary. Yeah, so we've got a lot to get through and we've got several speakers, so I'm going to go ahead and jump into it. First off, we're going to kind of recap what we're looking at weather going into the fall. So we've gotten into a lot better shape here over the summer, at least on the eastern side of the U.S. So as of the latest drought monitor, you can see that about 50% of the U.S. is not in drought, which if you just compare back to the spring, so March, we're improved quite a bit because at that point it was only about a third of it. So drought has improved for particularly the east side of the U.S. and the northern plains. And what that's done is it's really given some confidence for the corn crop, the hay crop, and then also for some heifer retention and growth to the herd. So we'll get into that here in just a bit. But a headwind continues to be that we're in this La Nina to neutral pattern. So we've been in a neutral pattern here for a while. And if you look at this probabilities, we're probably going to stay neutral to La Nina for the foreseeable future. So El Nino is typically where we do tend to see the best pasture conditions and the most moisture throughout the whole U.S. And at least for the foreseeable future, we don't think we'll be shifting into that. But if we can keep getting the timely precipitation, we're at least in decent shape here heading into the fall. Expectations for the corn crop this year is we're going to be looking at record production. So the latest WASDE report came out a week and a half ago, and it showed a few million more acres than what we expected to see, and then also adjusted the yield to show record yield. So that tells us that crop conditions are pretty strong. If we look at moisture through the main corn states, a lot of them are in their top 10 year going back the last 50 years. So pretty good precipitation and then more acres makes it so that we're looking at the record corn production by a pretty wide margin here in 2025. But with that, we are seeing more usage expectations, so more for ethanol, more for feed and residuals, and more exports. So stocks to use is at 13 and 13.3%. And basically that puts us in, corn is going to stay range bound, similar to what we saw last year. So right around $4, $4 to $4.50 is kind of the range we would expect it to be at as we look into the new crop year. And a lot of this is the really large production that we're expecting here. So supply expectations for cattle. We'll get into this and then we'll get into the market, the prices and what we're seeing there and expecting. But to start out, supply, we're continuing to see a large decline in non-fed slaughter. So we're tracking to be, so after a 1 million head decline last year here in the cow slaughter, we're tracking to be down another 600,000 this year. So dairy year to date is running down about 100,000, and beef cow slaughter is down 275,000 year to date. So pretty significant decline from what was already smaller a year ago, that tells us that a lot of the culling that was going to take place has taken place, and also that those that are keeping them maybe a little bit longer are looking to expand and maybe don't have the replacement heifers yet. So we haven't seen the replacement heifer number increase yet, at least according to the USDA numbers, but we are expecting to see that because if we look at some of the metrics, for one, we are seeing a few fewer heifers in the sales. So if we look at the heifers as a percent of the sales, this is weekly data, so you can see big swings week to week. But generally, here in the last month and a half, we've been at the bottom of this range. So that tells us that fewer heifers are hitting the sales, maybe more retention there. And that makes sense with the improved drought conditions, and especially compared to the blue line there and the red line, so the last 2 years. So definitely a lot fewer heifers as a percent than what we've seen the last couple of years. And then if we look at heifers as a percent of cattle on feed, you can see it's significantly declined. Now, we're not anywhere near where we were in 2014-15, whenever we saw that huge retention and then increase to the cow herd. For one, we don't think that we're expanding nearly as aggressively as what we saw in the last cattle cycle. But also, if you consider that the offspring from the dairy herd used to be primarily the male steers or bulls coming from the dairy cow, and now it's with all the beef on dairy, it's about half heifers and half steers. So that does increase the percent anyways, but still we are relatively down from what we've seen the last couple of years, which also is a sign for expansion. But still, we're looking at really tight supplies. It's going to take some time before those heifers have a calf, obviously. And we're looking at the tightest outside supply that we've seen, at least in the last 25 years. And if we went further back, it'd be even more. Part of this is that we do place cattle on feed for longer, but then there's also the heifer retention, and then also the lack of cattle coming from Mexico. So sometimes those cattle would be placed out on grass first, and so they would count as an outside supply at that point. This year we didn't see that, obviously, since we shut down exports last November. They opened back up a bit, but then have closed down since then. And we're just not going to see those cattle, or we're not expecting to see those cattle come in now for this year, it's looking like. So if the border remains closed for the rest of the year, this would say that we're at 225,000, which if we look the last several years, we're between 1.2 and 1.3 million feeders coming from Mexico typically. And so that's what we would have expected going into this year. And so without those, that does tighten the supply further, and it's also taking out of that outside supply. And that's part of the reason that we've seen such an explosion in this market is we were trading that the border was going to open back up, but then once it opened and then reclosed, and then with what we've heard since then, it seems like it's going to remain closed at least until the fall and probably for the remainder of the year. So that's a lot fewer cattle coming from that supply, and it's further tightening the on-feed supplies that we're seeing. So ultimately what that means is that we're tracking to be down about 1 million head for steer and heifer slaughter for this year. So that was after the slight increase that we saw last year, but down, of course, 1 million head from that 2022 high of this cycle. So that's a 2 million head decline in 2 years, and then another 800,000 after that. So expecting that even if we do start to see those Mexican cattle come in, we wouldn't see them in the supply chain until 2026 or 2027. So then that increase in 2027 is partially due to heifer retention that we're expecting to see, but also partially due to more Mexicans in the supply chain at that point. So near term, though, we are looking at extremely tight fed supplies. And then, of course, we saw the decline to the non-fed slaughter as well. So tightening supplies, which is normal in the cycle, but probably not looking to increase until we get into 2027. Part of that has been offset by the increase to weight. So last year we were up 27 pounds, which is the equivalent of 1 million head in additional slaughter. This year, we're on track to be up another 20 pounds, which obviously it's pretty rare to see back-to-back years of that kind of increase, but we've shifted to more fed slaughter for one thing, so fewer of the cow slaughters, which would lighten this average weight. And then also the feeding of exterior and adding those days on feed, along with the cheap corn, it makes sense that the trend that we're seeing is up another 20 pounds this year. And so that's the equivalent of 750,000 heads. So still down, but this does help to offset some of that loss to the beef production there. So ultimately, we're looking at beef production down about 2.5% this year, and then down another 2.5% next year, because we don't expect to continue to see another 20-pound increase to weight as we look on forward. And then by 2027, we do expect that we'll start to see that increase in beef production. But one way that we've offset the loss to the beef production has been an increase in imports. So we're tracking this year to be up 20% for imports, after being up 24% last year. So this is last year, then up another 20% this year. Now we are seeing more and more on the tariffs, which could slow them down, but to this point, we have seen beef imports run really strong. And with the way our prices and demand has been, it makes sense that we're going to keep bringing that beef in to help supplement that supply. Now, I will note that that's mostly lean beef imports that we're seeing, so mostly to supplement and get that ground beef supply, to get adequate ground beef supply. Then at the same time, we are looking at smaller exports as our production's just smaller, and then also our higher prices are going to force some of our export partners out of the market or to a smaller share of the market. But ultimately, we are on track to be up this year for per capita beef consumption. So that's with the increase in imports and the increase in weight, and then those declines to slaughter that I just talked about. So after being up over a pound last year, which was surprising, we're tracking to be up again this year before we do start to see that tighter domestic supply next year. So by next year, we do expect that even if imports stay at the level they finished this year, that decline to the slaughter and not the increase in weights to offset it will mean less beef in the system by 2026. But right now, we're looking at the largest supply since 2009, which just speaks to the demand that we've seen with the way the markets and the prices have been. So getting into demand, we just got the latest retail data, and we're surprised to see that it's continued to just step right on higher. So this blip in May was a caution flag for us. So maybe that was a sign that maybe consumers were pushing back and had decided that enough was enough. But then we've seen the last couple months of just large increases to that retail beef price. Not only the all fresh, so that's an average of all the retail beef, but also in ground beef. That's been extremely strong with no real mishaps of pulling back, and just speaks to our excellent demand, because if you look at all the other proteins compared to a year ago, beef is running up 9% in the all fresh, 13 or 14% for ground beef. And at the same time, we see about a 2% increase in pork, broilers up about 3%. So they're really tracking close to inflation, whereas beef has definitely outperformed inflation and the other proteins as we think about the retail market there, which just speaks to the strong consumer demand that we're continuing to see. So as you can see, this puts us at record large demand, or record strong demand, and record high prices. We do expect prices will continue to average higher into 2026, but we might see a pullback in demand, because then you are looking at a larger supplies. And while prices are probably going to increase still, probably not to the point of the decrease to supply. So that'll be a smaller or weaker demand measurably, but if you look historically, still looking at record demand levels is the expectation there. And if we look at the composite cutout, so this is the wholesale value of beef, we've seen extreme strength here. These dotted lines show the seasonal pattern, so they're marked to this right side of the axis. So they're not prices, but they're showing the pattern where you typically see the high coming in May or June, and then you see the pullback. This year, that high came later, so it came in late June or July. We did see this correction, this pullback, but then we've rallied again, which is pretty normal if you look at the seasonal ahead of Labor Day, but it isn't normal to take out that high that we see in the spring. So I think this is more driven by the tight supply along with the good demand, and that's why it's kind of breaking that seasonal pattern by this move here that we've seen. But then following this, you do tend to see that softness as we get into mid-September, October. That's where beef demand slows down a bit before we do see another spike in the holidays. And that's where we could see a little bit more strength in the seasonal suggest again because of the tight on-feed supply, the tight cattle supply there, really forcing prices higher throughout the whole system. So getting into the markets and prices for cattle, we are looking at more capacity than what we have cattle. So this red line is the weekly average fed slaughter for the year. So it's just taking that annual steer and heifer slaughter and putting it on a weekly basis. So you can see that last year we were down just slightly. This year, that million head decline shows up in this weekly slaughter here, and puts the slaughter quite a bit below capacity. Already, a lot of plants aren't running at 40 hours, so that keeps the leverage in the hands of the cattle feeder, and then down the chain, the feeder cattle and then calves as well. So that passes the value back because we do have fewer cattle than what we have capacity at this point. And we expect that to continue. To this point, all the major packing companies have announced that they're not planning to shut down capacity. So while it could still happen, and that would definitely be negative to the market, at this point, that's not our expectation. So what that does is that we call it leverage. That keeps the leverage in the hands of the cattle feeder and then ultimately the cattle producer. So we're looking at record high leverage if you look at the fed cattle price as a percent of the composite beef cutout price. So more dollars to retail and more dollars to the cutout allows more dollars back to the cattle producers. And we expect that to continue not only this year, but on into next year. Again, where you do tend to see that can soften is if we were to see the situation change where there was more cattle than what there was capacity, like we saw at the end of the previous cycle. Like, again, we don't expect that, but that would be a risk there. But if we look at where we are today, we are capturing a large percent of that retail price. So we don't tend to spend a lot of time where fed price is at above 24, 25% of the retail price. So what that tells us is that we're getting pretty stretched here, and we might be putting in the cycle high by the end of this year. So if you look, I mean, it's been a pretty aggressive rally here. The retail price, like we saw, has increased, but not to the rate of what the cattle prices have increased. So we are squeezing the buyers further out, down the system, and that tells us that we might be getting near a high. But to this point, we haven't seen it go the other way. We are still trending higher, but that is a risk, is that we just don't tend to spend a lot of time up here. And another thing is that historically, cattle cycles tend to be 10 to 11 years, 4 to 5 years in the upward part, and then 5 to 6 years on the downward part if we just look back at the previous cycles. What we're looking at is we're on year 5 of this cattle cycle. So it could continue on into new highs in 2026, but it also could go ahead and price that in this year. What we don't expect to see, though, is that rapid decline that we saw in the previous cycle, because that was really driven by all those plants closing down and then the aggressive expansion getting a lot more cattle than what we had capacity. Again, we don't expect that to be the case, but we are getting pretty stretched here if we think about cattle prices compared to what beef prices are at. So if we do start to see that beef demand soften, that's where we'd probably be at a cycle high. And then also once we do see larger supplies ahead, that would be another signal that the market would see and correct lower. But to this point, that's not the case, especially with the lack of Mexican cattle and then retaining heifers, that's just taking more cattle out of the supply and further tightening it. So that's allowed this this vertical move that we've seen here lately for the fed steer price. So as we look, we are obviously not really following this dotted gray seasonal pattern. The last few years, we have seen this high come more in June, late May to June, which was the expectation of our office this year. So we expected this was the high. But what we've seen since then is they shut down the Mexican border and in late May. And then they've also made announcements since that really don't put a lot of hope of Mexican cattle being in the fed system by the end of the year. So that's just further tightened the supply or further tightened the supply in the eyes of the market, and has allowed this next rally, this next step higher to occur. That along with the rally we've seen to the boxed beef prices. We could see some softness here as we do see the beef typically soften in September, October, but generally the tight supplies we think is going to be fairly supportive to these fed cattle unless something changes here. And then that's been passing down to the feeder cattle. So this has been a pretty vertical move, not really following the seasonal to a point, but futures prices are these dots here. You can see that they're also not looking for this weakness, this pullback that you tend to see towards the end of the year once we do get into larger supplies. And that's really going to be driven by those tight outside supplies. So this is a huge year-over-year increase if you look at the prices we're looking at today versus what we saw a year ago. And this is, of course, the annual average. So if we look, that's 315 for an annual average, but we're at 350 today, and futures contracts are all above 360. So obviously, I've seen a big move there, but this is about the time. This is once the Mexican border closed again. And so that's where we've seen more of a vertical move for these feeder cattle. And that was just the confirmation of tight supplies for the foreseeable future. But the other thing is that we have seen the movement in the live cattle. So that's the fed cattle futures contract. You can see that that's these top numbers are the fed cattle prices. And the left is looking at different cost of gains. With the prices of corn and what we're seeing in our closeout data, we're looking at cost of gains really around this 105 to 110 probably. And then if cattle, the futures contracts are at 240 like they're today, that says that the break-even level for feeders is right around this 350, 360 range. So while these prices are extremely elevated, it also does make sense with what we're seeing with the fed cattle prices and then corn. So the math does work out there that the break-evens are supporting this kind of market, but if we were to see corn move higher, if we were to see fed cattle move the other way, obviously that could move the other way in a hurry, and the lower values would make sense as well. This calf chart looks pretty similar. Maybe not as extreme of a move, or it doesn't look like as extreme of a move, but that's because they were already elevated. And then since the Mexican border have just stayed elevated, they don't have a futures contract to really trade the news there. But on track to average over $4 this year and then again next year. But you'll notice that this year we're looking at a 410 average, and we're also looking at that next year. So that's not looking at cattle staying at, obviously we've come a long way since the beginning of the year. And so we're close to 420 now. And that puts the average near that 410. Next year, we're going to come in over $4. But by mid-year, if we do start to see some of those imports come in, or those the heifer retention start having calves, we might start to see a little bit larger of supply, which would weigh on the market by mid next year. So don't expect it to stay elevated the whole time throughout there. This is an annual average, but definitely expecting support there just by the generally tight supplies. Just a quick point here. This is looking at the total live cattle open interest. And you can just see here that we're at really large levels here of open interest. That's this green line here. So there's a lot of funds in the market. There's a lot of people trading it. And what that tends to do is it introduces a lot of volatility. So if there were news that we got the screwworm or we were going to open the border, that would probably be negative to the markets. And if the funds were to all exit the market, especially I'm talking about the managed money funds, if they were to all exit the market, you could see the market flush more than what we would fundamentally expect and more than what fundamentally makes sense. But it would still be a market perspective that would flush a lot of money out and would limit the prices from there. Another thing that could do that would be an announcement if a packer were to close a plant. So those are definitely some risks on the radar, but at this point, we're just seeing a lot of money in the system, and that's allowed the futures to trade as strong as they have to the degree that they have lately. But ultimately, what we're looking at is stepping higher again for prices this year. But if you look across the board, we're looking at more steady next year, or maybe just a bit higher for next year's average. So we think the bulk of the price increase is there. Next year, we don't expect it to flush. We don't expect that large decline like we saw in the previous cycle to occur, because we're not going to get into a lot more supplies if we get into more supplies by mid next year. But still, I do think that we've put the bulk of the price increase for this cycle in. And the last point is that we are continuing to pass more of that money back into the cattle producer. So this green line represents the cow-calf producer, and with those 550 pound steer prices that we looked at, that puts a lot more revenue back into the cow-calf producer. And we've seen that really in the last 10 years. We've seen strong cow-calf margins, but never to this degree. So definitely a lot more money in the beef system, and it's getting passed back throughout as we are just in those tight supplies and keeping that money back into the producer side of things. So that's what I've got. I'll pass it off to Dr. Bozic.
Right. Let me share my screen. Okay. I must admit, Mary is a tough act to follow. You know, she's truly an expert, and I enjoyed your presentation, Mary. My job over the next 10, 15 minutes is to leave you with the feeling, is that it? Like, it cannot be this simple. There must be more to it. And with the idea that insurance is not something that is a big boogaboo that you need a master's degree to engage in, or otherwise you'll make some radical mistake. That it's designed to be easy. It's designed to be there when you need it, and that you're in good hands if you work with Farm Credit Mid-America agents, that are in your good hands that can walk you through any situation that may arise as a part of your risk management strategy. I just want to take a moment to share a little bit more why I'm here. So I don't sell insurance, and my company is, think of that as a geek squad. Like, if you've ever been to Best Buy, buy a laptop, etc., there are always these nerdy guys in the back, and they help you fix stuff, right? But they don't make laptops, they don't sell laptops directly, etc. So in the same way here, what my company does, we design insurance. We work with USDA, with U.S. Department of Agriculture, Risk Management Agency, to make sure that the insurance rates are done properly, that the policy and procedure is done in a way that protects the program integrity, but also doesn't make your life miserable if you want to use these programs. And it's an ongoing process. We are very grateful for the relationship with Farm Credit, and particularly their mission to serve every producer, coast to coast and all 50 states. So with that, I'm going to introduce the topic in this way. Things are great right now, as you've heard from Mary. There's a lot of money in the cattle sector right now, but we all know that things can turn ugly. So I'm going to give you an example from summer 2015. That was the first year. Mary showed us the chart with the cycles. That was the first year when the cycle turned. In October 2015 futures Back in March, April, they were at 200, and in March 2015, they were at $216, which already sounds super low relative to where they are today, right? But by the end of summer, by the fall, they fell down to 193. And that was a pretty dramatic decline in prices. What happened? Well, the demand for fed cattle weakened. We had cheap pork, chicken was cheap. We had increased beef inventories. We have stronger U.S. dollars. So a lot of things coalesced to, and of course it was a turn of the cycle to bring the prices lower that year. But I also don't want to be Mr. Doomsday. Like we all know that not every year the prices fall, and the last few years have been a good example. But the year I'm going to use in my examples here is again 2014. That was the last year before the cycle turn. And again, I'm going to use October futures. They started at 175 in March, and they ended up almost 240 by the time October rolled around. So just the opposite situation, the one year to the next, very different worlds. So in 2014, we had tight cattle supplies. A lot of factors came together to push these markets higher. And one lesson, I guess, here for us is that just a year after we thought prices are great, we had the biggest downshift in prices. So what's the goal here? Why do we engage in insurance? And if you don't remember anything else, when you go to sleep tonight, I want you to have this picture in mind: the cow with the flowers. Now, I did look for a black cow in front of flowers, but I couldn't find a stock image of that, so that's why I got a black and white cow there. The goal is to limit the downside, but enjoy the blue sky. What does that mean? When the prices go down, the insurance is there to provide a floor to make sure that you may lose a few bucks, but you don't lose your business. When the prices go up, as they have been going last few years, then the insurance is not going to stand in your way. You enjoy the blue sky, you enjoy the high margins. That's what we want. The protection on the downside, but all of the upside or most of the upside to stay with your business. So with that, I'm going to try to convince you over the next few slides that Livestock Risk Protection, or LRP, and as it's abbreviated, is a very simple product. So we have some things that USDA will provide, and then you have some things that you will choose as a livestock producer. So what does USDA provide? We publish the expected prices. We call them, the fancy term is expected ending value. So that is our version of futures prices. We look at the futures prices every day, and then we make it. Futures prices only trade so many months per year, but we publish expected prices on a particular day. And they are typically weighted average of surrounding futures prices, nothing really fancy there. So we publish expected prices. That's what market thinks is going to happen at the time when you're going to market your cattle. The coverage price is very close to expected price. Starting last year, you don't even have to take any deductible. But if you don't want to take high level of protection, you can go lower. You can take a deductible would be on other insurance programs. And then the coverage price is the place where you set your floor. You will pay a premium, and that premium is subsidized. It's subsidized 35%. So the taxpayer shares in your purchase because the taxpayer wants you successful in your business. And then the end date is the date when the insurance ends. So on that end date, we will look at what the actual prices were and to see whether you're due any indemnities. The actual ending value is, again, just a fancy term for actual price, what really happened with feeder cattle index on that particular day. And unlike the expected price, which is sort of our methodology for inferring what will feeder cattle index be on a particular day, the actual ending value is truly just a feeder cattle index for steers weights too. That's the cattle with between 600 and 1,000 pounds. For heifers, for lighter weight cattle, for dairy cattle, we kind of shift those feeder cattle index up and down a little bit. We'll talk about that later. But for the base category, it's really just a feeder cattle index. So you don't get the protection against your local basis, your local what the auction is paying, but you do get a protection for the national price going up and down, the feeder cattle index. So those are the prices. You choose the expected price, coverage price, you get the actual price. But what do you actually choose? What is your choice? Your choice is first the target weight. So that how heavy will your cattle be at the time when you intend to sell it. You choose number of head. You don't have to protect your entire herd. You can say, today I'm going to buy coverage for 25 head, and I'm going to call my agent 2 weeks later, buy another 20, cover another 25 head, and you can do that layering in if you wish. Or you can do it all at once and be done with it. So the number of head is what you need to choose every time you make a purchase. Sales effective date. There is no particular specific date by which you have to buy insurance. If you think that today is a good moment to do it, you should do it today. If you think that you should wait until next week, there's going to be another opportunity next week. So you can choose to buy insurance anywhere 52 weeks down to 13 weeks before the target date when you believe that you will be selling your livestock. So that's that endorsement length, how far out you want to go. So you want a coverage that will, for cattle, it will be sold in 3 months or 4 months or 5 months, and you can go up to 12 months out. So then let's go through what happens at the end of the coverage. So you purchased insurance, you committed to paying the premium, and now the time came for you to sell your cattle. What happens? Well, there are two situations. The first situation is when the prices went down relative to what they were expected at. So if the actual price is lower than the coverage price, you get a difference. And that's your indemnity per hundredweight. Then it gets multiplied by the target weight. So to get the indemnity per head, and then it gets multiplied by the number of head to get your total indemnity. Very simple. In any case, whether you get indemnity or not, you do have to pay the premium. In the same way that if you buy car insurance, for the month, you pay the premium whether you have a car accident or not, right? So about 2 months after the coverage ends, you will get a bill. There'll be a subsidized premium per hundredweight. What's your total premium? Multiply subsidized premium per hundredweight by the target weight of your animal to get a premium owed per head. Multiply that by the number of head. That's your total premium. And the unique feature of LRP, what distinguishes LRP from any CME futures, options, any other insurance that you may be buying. I'm not talking about crop insurance, but let's say life insurance, car insurance, house insurance, all the other insurance on the private market, you have to pay up front. So when I protect this house, I have to pay at the start of the year for the year that comes. With LRP, you don't get paid. You don't pay any premium until 2 months after the insurance ends. So it's very, very cash flow friendly. You basically can cover the premium from the revenue that you earned by selling your livestock. That's the idea. Let's go through this example of 2014 and 2015. I'm going to start first with the ugly year, with the 2015 year. And we'll see how the insurance helped in that year. So let me switch to a laser. So let's say that you purchased insurance on May 6th and you intended to sell your animals or in the first half of November. So you do the end date of November 4th. So on that May 6th, that afternoon, the published price was $215.30 per hundredweight. And the highest coverage price you could buy was $214.08. Now, these days, you can always have the coverage price that's exactly equal to the expected price. Back in the old days, before my company took over maintenance of this product, you had to go a little bit, you had to have a little bit of a deductible. You no longer have to have deductible. So back then, coverage price $214. The premium, subsidized premium, was just short of $6 per hundredweight. So let's say that you set the target weight at 600 pounds or 600 weights, and you had 50 head to protect. The total premium was $1,776, and that's the price of your freedom. I know this is a cheesy joke, but I did not choose this example to produce this number. When I saw this number, when I was creating an example, I was like, oh, this is perfect. I got to use this in a cheesy way. All right, so this is your price of freedom, your total premium, $1,776. Okay. So then what happened that year? The actual ending value or the actual price dropped a lot. You see what happened with futures. The feeder cattle index on November 4th was 191.80. And you got the difference. You got the difference between the coverage price and the actual price. So 214 minus 191 plus change, that's $22.28 per hundredweight. Remember, you had covered you set the target weight at 6 weights or 600 pounds. So indemnity per head was over $130. And when you multiply that by 50 head, you ended up with $6,684. Even after you pay the premium, you still took home free and clear $4,908. So again, the year turned out to be bad, but your bank account didn't look as ugly because the insurance was there to help you. Now, let's see what happened in a prior year, in 2014, when the prices went up. So we're going to do the same exercise. So on April 24th, you purchased the insurance. You didn't know how the year is going to turn out. If you knew that the prices were going to go up, of course you wouldn't buy insurance. But back on April 24th, you didn't know what the prices were going to do. Just in the same way that we don't know today what they will be in November or March next year. We can do an outlook, but nobody knows for sure. Then the end date was October 24th. That's what you chose on your insurance purchase. Expected price was $185, coverage price $184. The premium after subsidy just over $3, just a hair over $3 per hundredweight, and your total premium that you committed to paying was just over $900. Your total expected revenue. So now this is assuming no basis. This is assuming that you're getting paid right on the feeder cattle index. I know that's a simplification, but I'm trying to illustrate with a fairly simple example here. So give me some grace. So your total expected revenue was $55,500 and change dollars. So what happened with actual prices? They actually went up. That was a great year. So the prices went up to $238. Did you get an indemnity? You didn't need it because the price was higher than what it was expected to be. So there was no indemnity. Your total actual revenue per head, when you multiply this price by the 600 pounds, you get $1,429 per head if your cattle actually did weigh exactly that much, right? So your total actual revenue, again, bear with me, simplification, over $71,000. So just took this 1,400, multiplied it by 50 head, that's $71,000. So your actual revenue in late October ended up being over $15,000 higher than what you expected it would be back in April. And a small share of that, small sliver of that went to pay for the premium. But in the end, you were better off by the end of October than you thought you were going to be back in April. And that 918, that's the price of blue sky, because things could have gone down. You could have been worse off. When things went up, you grabbed all that additional windfall revenue that was yours to keep. Government didn't come after it, or your insurance carrier. So going backwards. So how did this work out over the last 14 years, going back to 2010? So these are the years that I illustrated. This is your 2015, where you got a big payout. This was 2014, when you had to pay some premium. Now, these dates are slightly different in this chart than the previous slide. So this may be a little different than what you saw the previous chart. So notice that the green bar is very high, and there is no year with a red bar of that same magnitude going in the other direction. The most you can leave on the table is the premium, and the most you can gain is a big amount if markets go down a lot. Now, some of you are looking at this chart and you're counting 1, 2, 3, 4, 5, 6 years in a row of no indemnity, or if we did get the indemnity, it wasn't high enough to cover the premium check. So should you really buy this insurance? I want it to pay out. You can say, I want to buy insurance when it pays out. I heard at a training event yesterday held by my friends, I heard a wonderful statement that I had to use today. Do you want your life insurance to pay out? You should be thinking about LRP in the same way. Now, if something happens to me, I want my life insurance to pay out. But if I could have it in such a way that I'm actually staying alive and I don't need life insurance, thank you very much. I'll take that route. So, do you want your life insurance to pay out? Do you really want your LRP to pay out? Because when LRP doesn't pay out, that means that you're much better off. Typically, you're much better off than you thought you were going to be, because we are in a rally. And nobody knows whether we are going to have a rally or not. Things can move south in a hurry. So the other point here is that this is not just a risk management system. It is also a net income booster. Why? Because it's subsidized. See, when you buy a typical auto or home insurance, for every dollar that you pay in insurance, you can expect to get 60 cents back. Now, most of the time you don't get anything, and once in a blue moon, or even less often than that, you will get a big check because you totaled your car or something bad happened to your house. But when you look at all of the premium nationwide that people pay for car insurance, and all of the payments that the car insurers, Geico's and others, pay to the poor folk that had a car accident, for every dollar that went in, 60 cents went out. When you look at doing risk management on a Chicago Mercantile Exchange, you have to pay your broker, right? You have to pay the commission. So for every dollar that you put in, on average, you will get 95 cents back. You're going to pay that 5 cents for the privilege of doing long-term, for the privilege of doing risk management. But long-term, for every dollar that you put into LRP, you can expect to get $1.35 back. That's a 35% return on investment. Beat that, Warren Buffett. Like, you guys can be better investors than Warren Buffett. I don't want to sell insurance just on subsidy, but it would be foolish to ignore the subsidy, because it makes everything easier to justify, and makes it easier to start something that perhaps you've never done before. So I want to walk you a little bit through what others are doing, what's happening in the industry right now, so that it's not just, oh yeah, Dr. Bozic said this is a good program, but is everybody really using it? When my company got involved with livestock insurance, the entire sector, that was 2018, the entire sector was less than $20 million a year in premium. Now we're going to cross, probably this crop year, we're going to cross 2 billion with a B. $2 billion in premium. Of that, over $1 billion is livestock risk protection. DRP, that's dairy stuff, LGM, there's some hogs there's some cattle, but the big chunk of the livestock insurance sector is this program that we are covering today, livestock risk protection. Within livestock risk protection, the biggest commodity is beef. And within beef, we anticipate that about 1 in 4 feeders in the country is covered by LRP, but on the fed side, we have more work to do to make the program better. We can talk in one of the forthcoming, we do a weekly webinars, by the way, for farm credit customers. You can join us every Wednesday at 11 on dairy stuff, and then every other week, on Tuesdays at 11 on cattle markets. That said, we do have more work to do to improve the fed cattle program, and we have something coming up just in the next few months to address the issues there. We've set the price for LRP for the basic category that corresponds very closely to how CME calculates the feeder cattle index. CME feeder cattle index covers the cattle sold in the 700 to 900 pounds, or 899 to be precise. In LRP, the category goes from 600 pounds to 1,000 pounds. And that one is priced right off the futures and settles just against the feeder cattle index. But then for heifers in that weight category, we multiply everything by 90%. So we scale down a little bit the expected price, we scale down a little bit the indemnity, etc. For lightweight cattle, we do the opposite. We multiply everything by 1.1, etc. These methodologies can be approved, but if you ever hear the term price adjustment factor, that's what it is. We're trying to find the appropriate price for different kinds of cattle. What is the typical weight that people actually do use, do put on their insurance purchases? Well, there are two buckets. This is in the 100 100-pound range. There are two ranges that are very popular. 500 to 600 pounds is very popular, and then 800 to 900 pounds is very popular. After that, you have 700 to 800, and 900 to 10 weight also has some volume. The other categories, the other ranges are not used very frequently. And the other thing to keep in mind, and this is my last slide, I'll wrap up with this, is that this program is simple, it works, but it also gets better every year. Every year, my team, working with good agents such as Austin and his team and others around the country, we try to move the frontier further, add coverages to situations that were not coverable before. So I'm going to give you a few examples. This year, we introduced new coverage for beef on dairy. We are calling that unborn cows, and also for dairy cows. Next year, we hope to extend this to beef cows as well. We don't have that currently, but we'll work on that for the next year. This year, we introduced a new rule that for stockers that as soon as they commit to buying livestock, cattle on a forward contract or a video auction, as soon as they have a paper that says, I'm committed to take delivery, let's say 3 months later, they can immediately buy livestock risk protection. They have a price risk, therefore they can get insurance. And then we also made the LRP more cash flow friendly by moving the premium billing date further out, et cetera, et cetera. So I don't want to drown you with details. There's only so much that one can take in an hour-long webinar. But I do want to point out this is a simple product. It works, and think of the blue sky. That's what really it gives you. It gives you the ability to enjoy your life knowing that you won't lose your pants when we turn the cycle that Mary talked about. So with that, we'll wrap up here and pass on to Austin for the last section in today. Austin, it's all yours.
Thanks, Marin. Very informative as always. I like the blue sky analogy. So appreciate you all hanging with us this evening. Bear with me just a few moments. I'll get my screen shared here. And so Mary gave us an update on, kind of the market environment where we stand currently. And Marin gave us a really nice, excellent dive into the basics of LRP. He did a lot of talking about, conversations that I would have, when first meeting a producer. And so my job here as we wrap this thing up tonight is just try and tie all this in together for you as a producer in the next 10 minutes here or so. And so what you're seeing here on your screen is a snapshot of our livestock insurance analyzer. And this is a tool that Dr. Bozic and his team have built out for us as agents here as Farm Credit exclusively for us. And then also, as much as it is for us as agents, it's as much for you as the producer as well. So if you're an LRP customer of ours at Farm Credit, you have the same access to this tool that I do, or any of our other agents out there selling insurance do as well. And so the reason I bring that up is there's a lot of resources, time, and money that have gone into creating a tool like this. And I think it's pretty neat that Farm Credit agents are the only ones out there that have access to it. And as such, you as our customers are the only ones that have access to it as well. And so whenever I'm working with a customer for the first time, we customize this tool to make sure that it fits your operation specifically. So whether you are a cow-calf producer, whether you're a traditional stock or backgrounder operation, or whether you're a feedlot operation, we work with all types of those operations. We can customize this to show numbers that are pertinent to what you're doing on the farm on a day-to-day basis and make sure that it's what you want to see. And so, as Marin went through the basics of LRP there and gave some examples of how it has worked historically, I thought I would just quickly run through you some numbers based on today and what the market is doing today. As Mary pointed out, we're at all-time highs in this cattle market. It's both very exciting time to be in the cattle business and also a very stressful time for some folks out there, especially if we're buying cattle in this market. And so our job at Farm Credit as livestock agents is really just to help you as the producer protect your bottom side as much as we can while keeping that blue sky open, as Marin so eloquently pointed out there. And so what you're seeing, this is my default screen, which would be Steers weight 2 category. So again, as Marin pointed out, would capture anything between a target weight of 600 pounds all the way up to 1,000 pounds. And I've got mine set today at 8 weights. And so you are seeing every single contract that you could put on, every single endorsement or contract, as it's often referred to, for LRP for the shortest time frame, which right now would be 13-week contract, which would take us out to about the end of November. And then these run in 4-week intervals all the way out to a year as the farthest that we could go out at 52 weeks. And so this kind of gives you an idea of what that would look like on an 8-weight steer or steers in the weight 2 category. This is essentially the feeder cattle futures market that closed today. So these are all today's closing prices. This is 100% coverage. So you as the producer have the ability to go out and lock in today's closing price, 100% of that for each of these months going all the way out to a year. And as you can see, this is the producer premium column. This will get more expensive the farther that we go out in time. It makes sense, right? We're protecting more time risk in the market. There's more time for things to get a little bit hairy, and you have more time liability there, as we often refer to. So that is a common theme. Doesn't always match up perfectly that way, but generally speaking, the farther that we go out, the more expensive it will get. And then the net guarantee is very important for producers as well, which is just the coverage price minus the premium that you would pay as your producer. So think of this as kind of your net floor, so to speak. So let's jump into one of these and kind of walk through what this would look like today. So again, keeping that same example, steers weight 2 category, we're looking at a 13-week endorsement or contract that we could put on, taking us to the end of November currently. And so if I'm a producer, I can go out today and lock in 100% of today's closing price, which would be $361.47. It would cost me $11.12 a hundredweight to go out and put that coverage on, which would make my net floor $350.35. And so just, an example of how this would work, and going off of Marin's example of 2014, if the feeder cattle index were to close, what RMA is going to do is they're going to go out, and on November 27th, the day after this contract ends, they're going to go out and compare that day's closing price of the feeder cattle index with any price adjustment factors in, which in steers weight 2 there is not. And if it were to close any lower than $361.47, insurance starts kicking in for you, right? Now there's that premium that you have to pay at the end of the insurance period. And so that indemnity would pay down all of that premium first, and then would pay any excess to you as the producer. So 2 numbers are important to you: that coverage price, what you pay, and then ultimately that net guarantee. So if the market were to close at all below $350.35, it would pay all of your premium down as a producer and would start paying you dollar for dollar, cent for cent, every amount that the feeder cattle index closes lower than your coverage price. And so just a quick example of how that would work. These are all the different coverage levels that are available currently, and these are available at every single endorsement, not just on a 13-week contract. So work with a lot of producers that take 100% coverage every time. They decided, hey, I want to try and get the most that I can out of this program. I want to utilize the subsidy. I want to lock in the highest floor possible in my operation. And there's absolutely nothing wrong with that. I'll have a handful of conversations with producers on a daily basis of, you might call me up and say, hey, Austin, I'm interested in covering some risk for a group of cattle that I have, but $350 is not a price floor that I need. I'm actually profitable at $340 and above. Well, that's excellent. And right now you can set a price floor at $340 at 96% coverage and actually cut your premium in half by doing so. And so the idea is not to try and make this as inexpensive for you as possible, but the idea is to really find a level that makes sense and a trade-off that makes sense when we're thinking of coverage prices, floors that you need to set as a producer, and then the premium that you need to pay as well. So just a couple of things very quickly that we can do in this tool. Marin mentioned puts and futures, and so I have a lot of customers that work with both strategies, LRP and also utilizing CME products together. And you might often hear folks referring to LRP as a quote unquote subsidized put option or comparing the two together. And there's a lot of similarities. There's also a lot of differences. But one thing that we can do within our insurance analyzer is look at the two together. And so anytime a customer wants to compare, well, what's my best option here, putting on LRP insurance or buying a put contract? And the largest benefit that LRP has is cost and no upfront cost, as Marin mentioned. And so I will often say as a rule of thumb to producers that LRP is going to cost you about 70% of what going out in the open market and purchasing a put contract will. Sometimes it's going to be a little bit higher than that. And as you can see here, sometimes it's going to be a little bit lower. But in general, RMA has designed this and Marin and his team as a way to be one of the most cost-effective ways that you as a producer can hedge your market risk. We can also look at historical examples. So just like what Marin was sharing, we can do this right in the tool with your specific operation and your scenario. So if we were to go and purchase this same style of endorsement at this time last year, or at this time back in 2022 or in 2019, or whichever year, we can look at how it would have performed over time. Obviously, there's going to be years where it's very advantageous to have it on, and there's going to be years where there were no indemnities paid out and you didn't need it. We were selling cattle at higher prices, which is always the best case scenario. And then finally, just want to wrap up with probably the second most utilized tool in the livestock analyzer tool is just the ability for you as a producer, when we have your operation set up here, is to track endorsements and keep all of this in somewhat of an organized fashion. If you've worked with insurance companies before, you know sometimes there's a lot of paperwork, things can get disorganized. We have designed this as a way to capture everything, all the contracts, all the positions that you have on with us at Farm Credit in a nice, neat, and concise fashion. And so as you can see here, this is just a demo screen. But as you start putting endorsements and positions on, we can track all of the coverage prices, all of the premiums, give a forecasted real-time indemnity, kind of a profit and loss scenario based upon what markets are doing currently, and allow you really to have access to all that and be able to track it without having to go back through a bunch of paperwork. So just a really nice, neat, organized way that we can help you as a producer organize that, and how I can help you manage future positions as well. So with that, I think we're a little bit over time, but just want to wrap things up. Again, thanks everybody for joining tonight. I know there's several watch parties out there, and we hope that you're having great conversations with the folks that you're with. I'm Austin Robinson. I'm the livestock product specialist at Farm Credit. We have a team of folks here that work with us. My contact information is on the screen. So if you're a producer and you want to talk about how LRP would work specific for your operation, feel free to reach out to me directly.
All right. Well, we want to thank our speakers for tonight, and we are now going to go into a little bit of a question and answer session. So if you have any questions, feel free to keep coming in the chat with those. But we're going to start off with one question. And Dr. Bozic, I think that this is for you. Where can someone go to follow the price that the LRP will use to determine if the policy will pay a premium to a producer? I assume that this number is based on an actual price that the producer can follow at any time during the contract.
Yeah, this is actually a question better addressed by Austin. We did build the tools in the livestock analyzer where we try to anticipate what the actual ending value will be, and then we update it every year, so you can sort of see, okay, I have my endorsement, my insurance coverage is ending on October 12th. Here's how the expected price for October 12th evolved over time. So typically that price is not publicly available, but we did build it in the livestock analyzer.
Okay. All right, Mary. With the feeder steer market, the buy-in bottom 450 to 500 pound steers versus the sellout at 800 to 850 pound steers, what does that margin look like over the next 6 months, 1 year, 2 years, 5 years? This is a great market, but buy-in versus sellout margin is a concern.
Yeah, that's a great point. Yeah, a lot can happen in the time that it takes them to go those 300 pounds. So that's definitely a good question. Hard to say what's going to happen for those. But I will say that on a percentage basis, the 550 pound animals have gone up the most. So The most leverage is going back to the cow-calf producer, and there is quite a bit of risk there for the stocker and feeder operator because not only do they have to buy in higher, but then there's a risk that it could move quite a bit lower before they end up selling them. So that's why those risk management tools we just went over are a great way to help protect that, because I agree, the margins are pretty slim there. And it really depends. The market would need to keep going higher to make those profitable with where the calves are at lately.
Okay. And then Dr. Bozic, what adjustments do you think we can expect to see with insurance products in 2026, that's a little dated, 2026 to 2027?
Yeah, so we're working on a couple of things. First, we think that the expected prices for LRP fed cattle should be higher. You got to keep in mind, I only got involved with LRP a few years ago. It's still a little bit of a fixer-upper, if you will, on some elements. The feeder cattle is working really well, but on the fed cattle side, there's really maybe the last 3 months of the year is when I would say the coverage is okay to buy right now. For other months, it depends on how risk averse you are. We're going to try to increase the expected ending values for fed cattle to the tune of several dollars. So it's going to be a very substantial increase in expected prices for at least 9 out of 12 months in a year. That's going to be a big change. I think that we're going to see that implemented sometimes March of 2026. We don't have to wait for the new crop year for that particular change. We are also going to try to simplify the drought exemption rule. So right now, we introduced that for the first time this year, that if you just you had bad luck and your pasture dried up, and that you have to sell your livestock before you thought you were going to, that there's some calculations that that we do to see whether you are eligible for easier rules to get the indemnity, to be eligible for indemnity, and we're going to try to make that closer to how FSA does business for the livestock indemnity program. Well, the other parts that we are looking into are adding coverage for the beef cows, and then expanding the dairy cows out to 52 weeks. So right now you can only buy dairy cows up to 13 weeks. We're going to try to push that to 52 weeks and then add the beef cows up to 13 weeks. Now you got to keep in mind, none of this has been approved by the government yet. This is just what I hope to bring to the market next summer, but it still needs to go through expert reviews, through government raising their hands, the board of directors of the Federal Crop Insurance Corporation, etc. So don't hold me to this. This is what I'm just trying to see happen. And then we also want to, the last thing, we want to add more flexibility to, not the last thing, but we want to add more flexibility to some stockers that are buying calves that are very, very light. So we want to treat them closer to how we treat cow-calf producers in terms of flexibility on forward contracts. I think that's going to make the program a little bit more fair. And then on the unborn bulls and heifers, the maximum weight you can cover right now is 600 pounds. We're going to try to lift that up to 1,000 pounds. On the dairy, predominantly dairy, we'll try to make the price adjustment factors more dynamic. We are currently monitoring to see how people react to that. We introduced that with the baby calves for dairy and the cows. And if that works out, I'm thinking that down the road we may want to introduce that for lighter beef cattle as well. I think that the premium at which they're selling right now is more than 10% over the cattle that's used for feeder cattle index. So we got to fix that down the road, and heifers as well. So there's always stuff that's happening. The other thing that we're working on is allowing people to use LGM and LRP on the same month. That's probably not the core concern for target audience tonight, so we don't have to go into details. But lastly, you have to keep in mind, everything that we do in these programs is because somebody raised their hand and said, hey guys, how about this? Can we make this happen? This would really help my operation. So if I didn't say something that you were hoping I would say, in this roadmap for the next year, do talk to Austin. Austin will talk to me about it, and we'll try to make it happen. We can't do everything immediately. It takes time, but we take very, very seriously every feedback that we get back on how the program works.
All right, thank you. And then Mary, any expectations regarding the New World screwworm and how big of an influence that will have on the market? And how is CattleFax thinking about this disease?
Yeah, so that's a tough one. No one knows for sure what's happening there, but they don't have it contained in Mexico. So we think the odds of it coming to the US are still pretty high, even with the border closed. But the closer we get into fall and the cooler weather tends to kill it off. So the closer we get to fall and we don't get it, the odds go down that we'll get it. But it would be a negative to the market. It would just make it harder for the flow of cattle, for one thing. It is an animal health risk. It would add to producer costs because there would probably be more steps to trade cattle and move cattle to make sure we're not spreading it. And then public perception is also a big risk there. So it depends on how the media grabs a hold of it and presents it. So definitely would be considered a headwind and a risk if it were to get here. At this point, we don't know if we're going to get it. But like I said, odds are going down as we do get closer to the cool weather because it does tend to die naturally then. And we are working on more of those sterile flies to kill it. So if we can make it till the cool weather before without getting it, I think the odds are that we can get enough sterile flies to control it. But at this point, no one really knows.
All right, thank you. Okay, that kind of wraps up the questions that we had in the chat. So with that, we're going to go ahead and wrap up. Again, this webinar is being recorded, and we will send this out to everyone that's registered after we end tonight. So be on the lookout for that in the next couple of days. And so with that, we really thank you again for joining us this evening, and we hope you have a good evening.